You know the old saying, right? Buy low, sell high. It's the first rule of investing. But what if I told you there's a way to flip that completely on its head? What if you could actually make money when a stock price goes down? It sounds kind of crazy, but it's a real strategy called short selling. And today we're going to break down exactly how it works, and just as importantly, how it can all go spectacularly wrong. So, on one side, you have the classic game plan we all know. You buy low, and you hope to sell high. Pretty straightforward. But on the other side, you've got short selling, which turns that whole idea upside down. Here, the goal is to sell high first, and then buy low later. That little reversal in the order changes everything, and it brings up one massive question.
And that's the big one, isn't it? I mean, how on earth can you sell a share of stock that you don't even have in the first place? It really does sound like some kind of financial magic trick, but it's not. To get our heads around it, let's follow a story.
Let's meet Zain. Now, Zain has been keeping a close eye on Honda Pakistan, and he's got a gut feeling. He believes their sales numbers for the year have been pretty bad, and because of that, he thinks the stock price is due for a fall. So he decides he wants to try and profit from that drop. How does he do it?
This is the basic playbook. First, Zain's broker lends him one share of stock, kind of like a library lending you a book. He immediately turns around and sells that borrowed share on the open market. Then he plays the waiting game. If he's right and the price drops, he buys the same share back at the new, cheaper price and returns it to his broker. The difference between what he sold it for and what he bought it for, well, that's his profit. Let's see how this works with some actual numbers.
Okay, so let's say the current price for a share of Honda is 400 rupees. Zain borrows one share and sells it immediately. That 400 rupees lands right in his account. But, and this is the important part, he's not in the clear yet. He still owes his broker one share of Honda stock. And just a week later, bingo, Zain's hunch was spot on. Honda announces their sales figures, and they are not good. Just like he thought, investors get nervous and the stock price starts to fall. This is the moment he's been waiting for.
The stock price tumbles all the way down to 200 rupees a share. Now's his chance. He takes some of that money from his account and buys one share at this new, much lower price. His debt to the broker is now settled.
So let's do the simple math here. He sold for 400, and then he bought it back for 200. After he returns the share, what's left over? A cool 200 rupee profit. It worked out perfectly. But what if his prediction had been wrong?
All right, let's hit rewind. Let's go all the way back to the moment Zain made that bet. But this time, let's imagine the story unfolds very, very differently. This is the flip side, the nightmare scenario that every short seller dreads.
In this version of the story, Zain's analysis was completely off. Honda holds a press conference, and the news is fantastic. Sales are actually up by a whopping 20%. This is amazing news for Honda, and absolutely terrible news for Zain.
Now remember, he still started out the same way. He sold that borrowed share for 400 rupees. That money is sitting in his account, but he still owes his broker one share of Honda, and he has to return it no matter what the price is.
With all the great sales news, investors rush to buy the stock, and the price doesn't just go up, it skyrockets to 600 rupees. Zain has to close his position. He has no choice but to go into the market and buy a share at this new, painfully high price.
Think about it. He only has 400 rupees from the initial sale, but now it costs 600 rupees to buy the share back. So not only is his potential profit completely gone, he has to pull an extra 200 rupees out of his own pocket just to cover the difference and settle his debt. A really painful loss. And that losing scenario right there perfectly illustrates the single biggest danger of short selling. It's a concept called asymmetrical risk. And if you're ever thinking about this stuff, understanding this idea is absolutely everything. So what does that mean in plain English? Well, it's pretty simple. Asymmetrical risk is just a situation where the amount of money you can possibly lose is not the same as the amount of money you could possibly win. And in the world of short selling, those two sides are dangerously, dramatically out of balance.
This right here lays out the terrifying math. On the profit side, your potential gain is capped. It's limited. If Zain shorts the stock at 400 rupees, the absolute most he can possibly make is 400 rupees. And that only happens if the company goes bankrupt and the stock goes to zero. But now look at the loss side. There is no limit. A stock's price can, in theory, rise forever. If that Honda stock had shot up to 1600 rupees, Zain's loss wouldn't be 200. It would be 1200 rupees. His potential for loss is infinitely greater than his maximum possible gain.
So what's the big takeaway from all this?
Short selling is a really powerful tool, no doubt about it, but it carries a kind of risk that's just in a different universe from traditional investing. And that brings us to a final word of caution.
And this really gets to the heart of the advice from our source material. For most people, and especially for anyone new to the market, the message is pretty clear. It's probably wise to stay away from high-wire acts like this. Instead, it points to the philosophy of legendary investors like Warren Buffett, whose whole game is about focusing on long-term growth, not making short-term debts.
And that really leaves us with the one big question you have to ask yourself. Sure, for professional traders who do this for a living, maybe that risk is part of the job. But for everyone else, you have to wonder, is a reward that is fundamentally limited ever truly worth a risk that is, quite literally, unlimited? That's the dangerous gamble, at the very heart of every single short sell.